What's up, everybody? Welcome to the Chaos. My name is Brad, and I have a special video for you today. See, there's an issue that I'm having with my pen position. I've been in it for so long, and I've been red on it for quite a while, and I've been asking myself, what other options do I have? And that is a play on words. I have some options calls that I'm looking at for potential leaps. Now, this is going to be an in-depth video, so if you're curious about this, we have some resources that you can go to, but I actually reached out to my buddy Don to help me try to figure out what's going to be the better option for me, to just stick with what I have as far as my positions is concerned, or is there some options that I may want to consider? So let's go ahead and bring Don in. Don, what's up, my man?
What's up, man? How you doing?
Good, brother. So I have this problem. I've been in Penn for a long time, as you know, and I've been averaging in. I have a fairly decent average, but it's just been kind of like it's stuck in this rut, in this sideways channel for quite a bit of time, and it's been really frustrating. And so I've had some questions. I got some questions as far as options are concerned. I know Fat Man Zoom loves leaps. I hear you talk about leaps all of the time, and so I'm considering actually selling my shares of Penn in exchange for some options. I think that Penn at least has the opportunity to get to $120 a share by potentially the middle of or maybe even the end of the year. We'll see how things go. But with the way that sports betting's been going and things reopening back up, I think it's certainly a reasonable area to consider.
Okay, so real quick, where do you think it's going by the end of the year? If you had to put a dollar amount, or give me a hypothetical, realistic, you can see it here.
Realistically, I think that $100 a share should not be unattainable for Penn by the end of the year.
Okay, okay, fine enough. Okay, and you're in how many shares?
I have 275 shares at $103 a share. So it's about $21,000 worth so far right now.
It's 21 right now,
Yeah.
or
Yeah.
okay,
Yeah.
so we're at 21 right now. Okay, so you're debating, should I put 21,000 worth into options, or should I match the same shares and control the same amount with a cheaper amount? Which
Yeah.
is
So I think that that's kind of where I'm coming with, because I know that with options you can kind of, you don't need necessarily as much capital to leverage this, to have the same amount of leverage. So right now I'm tying up 20 grand, and I feel like I can actually own the same amount of leverage, so having the power of the 275 shares of Penn National and using that capital somewhere else to kind of make up for some of my losses as I'm waiting for Penn to make the move.
right. Okay. So there's a couple things, and while we're going to get into it, there's a lot of ways for Delta, but Delta is going to be something we're going to be talking about because you're in essentially 275 hard Deltas. Those are shares.
Yeah.
So you can actually match that 275 soft Deltas in options contracts, and I can pull up you got my screen here.
Yep.
Uh,
There you go.
so just take a look at the pin chart real quick. So you think we're somewhere up here by December. You wouldn't want to just grab December contracts. You want to grab a leap, which is a year out. So we're definitely lighting out. I can see the sideways channel you're talking about. So if we pull up the options chain, let's go with just a solid January of 23. So we all know a contract is an option to purchase or sell 100 shares, but you don't actually control 100 shares. In fact, your deltas is how many shares you actually control. It's rated per share basis. Most of you guys just know the definition of how much it moves per dollar. But in
Yeah.
fact, that's the same as owning this delta right now. Deltas are 65. That's the same as owning 65 shares. This is 65 soft deltas. Again, shares are going to be your hard deltas. So you can jump up here and you can grab, you're in 275. So you could actually grab 3 of these and you'd be what, 12 grand in? 12 grand in, you'd have the exact same amount.
Yeah.
You would control the same. Now we know as that pushes up and gets further into the money, you eventually get to the 1-to-1 ratio. So you got an extra, 27 shares essentially.
Right.
Or you grab a few of these. Now, I don't like venturing out of the money. I like to just jump in, and I like to be talking about how deep I am in the money, not the hill I have to climb first and then get into the money. So I would stick somewhere in here. But that's why I said, depending on what move do you expect, because you can't just blanket this much out. This one's going to move, eventually it goes to a 1-to-1 ratio. You get an extra 9 deltas per each one. Where let's say you grab 275 deltas, soft deltas right now of this contract, and it pushes up. So that puts you at what? Just you'd probably end up being at five,
Yeah,
or unless you went shy. So you'd have five of these. And now, if all of these pushed up, that would be controlling 500 shares. So as that pushed up, not only would you make your money back faster, you would actually make more,
right. With
uh,
less capital, correct?
quite a bit less. Yeah, because each one of these will round up. We'll call it $2,000. You're in this 6,000, so you actually still have the exact. Oh, hang on. What am I? 10,000. 10,000 because you grabbed five of these. Uh, and all Penn would need to do is just move the well, it needs to at least move $20. With options, you are now. There's always the risk of you gave yourself a deadline. For instance, right now we have until these are January of 23. Um, this is someone who you're a swing trader, right? So you're going to be in and out of this thing. You will be out well before this,
Right.
but it's something to ask yourself: am I going to bag hold this forever and just continuously sell myself a position, or is this going to make a move, or am I going to get out? Even then, let's say Penn just tanks. Let's say something bad comes out and they go to $1. Let's just say everyone was surprised. Neo went down to $1 something, $2. If you did that right now, you would lose 21 grand on top of what you've already lost.
Right.
Where this gets completely smoked, you're going to be out half of that. So you've definitely already in that point managed risk quite a bit better. That's obviously worst case scenario. Bring it to the extreme. You'll manage it plenty in between. Uh, but yeah, that's how you would actually take a look as far as leaps go. Look at your deltas. What move do I expect? And if you think that movement's there, get a little bit. There's always a give and take. So by grabbing the closer to at the money, the less deltas, it's going to cost less, but your risk is more. You can grab these slower. These are going to move slower. Not quite as much risk. They're going to probably expire in the money. There's some intrinsic value to these, so they don't have the movement these will have.
And you're
Uh,
talking about going deep into the money on those as far as as far as the strikes price is concerned. For those of you who are watching who may not be aware, you're going deep in the money on calls that expire way out in advance, way into the future.
Yeah. Yeah. So these are a 30 strike on Penn. So you hear people, institutions taking synthetic long positions. They go deep in the money. They're looking for that 1-to-1 ratio or close to it because, like I just said, you could buy 94 shares of Penn, but Penn's $73. So just get your little calculators out with 73 times 94. And I can tell you right now, the $4,000 you're going to spend on this options contract is a lot cheaper. So they're actually saving a lot of capital. They're keeping the close to the 1-to-1 ratio instead of buying shares. So that's more when you hear somebody talk about a synthetic long position, that's the leaps they're grabbing is deep in the money. Where as we start pushing to the at the money, that's where the closer to us, I would say more speculative because you get closer to the 50-50. Is this going to go up? Is this going to go down?
Right.
But with greater risk, greater reward.
Yeah,
Uh,
so that's the kind of situation that I'm in, where I'm just kind of looking at this, at leaps as a potential alternative to still be in Penn because I do believe in it, and I think that there's a lot of potential here in the immediate to midterm type of future for this, and maybe it goes crazy as well, into $200 territory, but I could always get more leaps later on. But for me, I think that instead of just having all my capital tied up into shares, that this looks like a reasonable alternative, and then I still have other capital that I can do whatever I want with in the future. If Does that sound like an actual sound strategy? Like if somebody else was in my position, would that be something that you actually would consider doing?
it's something I literally just did not too long ago. I can't remember if I brought up on your channel or just mine, but I was in Clove shares and I had some calls, and just to free up the capital, instead of
Yeah,
having thousands of shares of Clove, I just bought December because Clove for me, I just assumed there's going to be the next spike. I was just waiting for that next one, and
right.
instead of just having a bunch of money tied up, I grabbed options. They were much cheaper, and when the move happened, I made much more. So I gave myself a deadline for that move to happen. That's where the risk is, that target practice. The move still has to happen, but when it does, you do make more. Did you just mention Penn might go to 200? Like just in that scenario, you would make more off of that than holding your shares. If you
Right.
bought the at the money's right here, the $70 strike, it goes to 200. These are going to be at the 1-to-1 ratio, and made a lot more. You're controlling more shares. You're just going to make more money that way.
Yeah.
The it's the give and take of the stock market. There's more risk because you do have that deadline. But you know how I like to do things. If I'm looking to hold this for the next 6 months, my options contract might be a year out. So, you know, I've got plenty of wiggle room. You're not running it right to the dirt, right to the deadline, and you'll just make more.
Yeah, I think it's a great strategy. And guys, let us know in the comments. Do you think that I should be selling my pen position in place of these leaps? I think that this might be something that I'm actually really considering and really leaning towards. But I definitely want to hear from you guys. Let us know in the comments below. And Don Fran from the Don Fran Show also has an excellent resource. If some of this was over your head, if you felt like you wanted to learn more about it, but you couldn't quite all wrap it up into this short video. Don, where can they find some more resources to learn from you?
On your website. The We Trade HQ website has my course on there. What we went over was one definition of delta. That's a very important Greek of this. It sounds like another language, but I promise it's not. But there's 11 ways you can look at the delta. So we just covered this much worth. Enough to get you guys in trouble, but enough to maybe dig yourself out of some stuff too.
Well, there you have it, guys. Thanks again so much for tuning in, and Don, thanks for helping me out, man. I really appreciate it.
Of course, man. That's what I'm here for.
That's gonna do it for us. Make sure you hit that like and subscribe, and we'll see you on the next one, which will be next Friday. We'll have options with Don next Friday as well. So make sure you're tuning in.
Awesome. I'll see you guys later.